So please, just a quick reminder, keep your devices on mute. If you have any questions during the presentation, please put them in the chat, which should be located in the bottom center of your screen. We do have several presenters and co-presenters on to assist in answering any questions you might have. And there will also be a Q&A once the presentation is complete. Please keep in mind that we will be recording this, as you know, and we will be sending out the post-viewing survey right after. So once you click out, once it's completed, it should pop right up on your screen for you to go ahead and answer those questions. And then it'll also be sent again later on with those attending certificates and the recording and any other goodies our lovely presenter will send along. So with all of that being said, I also want to make you aware of the fact that we are giving a free NCCA annual membership to one of the lucky attendees today. So once we have completed the presentation, please answer that post-viewing survey. That will be your ticket into the pot. So we will draw at random, and then we will notify you through the email that you provided us on that post-viewing survey. So I'm very excited for this presentation, and I'm going to go ahead and give it away to our fearless leader, our director, Cindy Lanehoff, to make introductions.
Speaking of fearless, I'm talking to a whole audience of fearless, essential people. And I know, as Mariah said, everybody's really busy, but I'm glad that several of you found the time to participate today, because you are going to learn how to access thousands and thousands of dollars that you may not be aware that you are eligible for. And hopefully everybody is, but this presentation will help you learn if you are and how to move forward with getting it. With us today is Bob Kirshner, who has been with us before with some great information about leading your business into success. Bob is a senior business leader. He's passionate about early childhood education and has worked with hundreds of childcare centers to help owners improve their financial performance, as well as their personal ownership experience. He is a partner to one of our wonderful partners, Caroline Jens, who's with Childcare Biz, who can always help owners with many different challenges and issues. And if you're not familiar with Caroline, I hope you'll Google Childcare Biz and learn more about her. They are here today with some new friends to talk to you about what is known as the Employee Retention Credit, tax credit. And again, listen closely. There is a lot of facts, but don't hesitate to ask questions and make a connection following this presentation so that you can learn more about how to get the money that you may be eligible for and that many have already gotten. Take it away, Bob.
All right. Thank you, Cindy. First of all, hello, and thank you for attending today's webinar. You know, Carol and I are really interested in promoting the Employee Retention Tax Credit to NCCA and its members, but also to the entire childcare industry. And Carol and I work with a large number of childcare providers. And over the last few months, particularly, we've discovered that many owners don't know what the ERTC is. Or if they know about it, they haven't applied yet. And we're asking ourselves why. Other owners have discounted the program, usually because they're misinformed about the qualifications for the program. Or they've been told by their advisors and even by their CPAs that they don't qualify, which can be very, very wrong. It can cost hundreds of thousands of dollars to certain providers. Carol and I really don't want a single child care provider to miss out on the ERTC opportunity to qualify and file for a potentially very large payment from the IRS. And this payment, it can be in an amount that can be a game changer. We've all heard that. People say it's a game changer. Well, this really is. And what's unique about this can be a game changer for your business as well as for you personally. And our presenter today, Jeremy, is going to explain that there really aren't any strings attached to this. You can spend it in any way you want. So with that, let me tell you about Jeremy, our presenter today. Jeremy is the Vice President of Business Development with Jorns Associates CPA. And Jorns is a specialty tax firm that's focused on helping both nonprofit and for-profit businesses to qualify and file for the employee retention tax credit. With their in-depth knowledge and understanding of the CARES Act, and also the information and the guidance from the IRS for ERTC, Jorns really is uniquely qualified to assist child care owners, child care providers, to maximize their employee retention tax credit. Again, I've never seen a program like this before that's sitting out there on the table where folks haven't taken advantage of it and the difference it can make in your business and your life. So let me go ahead and turn the webinar over to Jeremy. But again, once again, I want to thank everyone for attending, and we look forward to your follow-up with Jeremy and Jorns. Thank you. Jeremy, I'll let you take over.
Thank you, Bob. I appreciate it. And thanks everybody for joining. I know everybody's got busy schedules and things going on. So I want to make the most use out of this time and get this information out to everybody. And so with that, we will just start running through this. I know there's a chat available. So if you guys have questions as we go through this, definitely post those to the chat, and then we'll do a Q&A at the end of this so we can kind of answer everybody's specific questions. So a little bit about Jorns. We were created to assist businesses navigate the complex rules and regulations surrounding all of the economic stimulus programs. When COVID broke out, the federal government stepped in and released some incentives and stimulus programs to be able to help struggling businesses, overcome some of those hurdles and really, survive through that time period. But it's complex and there's a lot of different rules that go along with it. And it's not normally, they didn't release a real clear playbook. And so we really, stepped in to really help businesses, kind of go through that complex process and try to make this as easy as possible. And we help educate business owners, about stimulus funds that are earmarked, for companies, that they have, and really education is a large piece of our practice, making sure this information is out there for everybody to utilize and take advantage of. So Jorns is comprised of tax credit specialists. We've got decades of experience. We employ some former IRS auditors, CPAs, attorneys, and paralegals to be able to navigate the rules and regulations that the IRS and the federal government's put out there in order to obtain these tax credits and incentives that are available. So ERTC, or ERC as it said, stands for the Employee Retention Credit or Employee Retention Tax Credit. This was released back in March 2020 as part of the CARES Act, along with PPP and enhanced unemployment benefits and $600 stimulus checks. But unfortunately, ERC really took a backseat to what was going on back in March 2020. Everybody was very focused on PPP, and this kind of got put on the back shelf. And what's happened over the last 18 to 20 months is this has been adjusted and amended multiple times to really broaden what's available and broaden who it's available to. And that's some of the stuff we're going to go through today. And like I said previously, there isn't a clear playbook, and the IRS and the feds have not done necessarily the best job about getting this information out to the people who need it most. And that's you guys and business owners and CPAs and accounting firms. And so we're going to go through a lot of that today. So some base requirements for ERTC: 3 to 499 employees per EIN, per federal employee identification number. I know there are a lot of childcare organizations that have multi-unit or multi-location, and we can work with those, those multi-units as well. Outside of that 3 to 499 number. Must be W-2 employees. Unfortunately, there's nothing available for 1099 contractors. And then they must have had some impact from the pandemic. And this impact does not necessarily have to be a reduction in revenue. You guys will see that quite a few times as we go through this presentation where it says this does not have to be a reduction in revenue. There's a common misconception out there that you have to have lost money in order to qualify for this. And originally that may have been the case, but as they broaden this, they open that up to people that were impacted in other ways versus just a reduction in gross receipts. So some highlights on ERC or ERTC was originally earmarked with $1.9 trillion worth of federal money in order to supply this and get this out to businesses. What's unique about ERC is it's set up as a tax credit. So there really is no limit to the amount of money that's available to businesses out there. This was designed to be able to be offered to every business across the country that may qualify, like any other tax credit that the IRS does. And so there really is no limit as far as the total amount of money that they're willing to put out. It is worth up to $26,000 per employee. This is the max benefit. We'll talk about how that's calculated as we go through here, but up to $26,000. And then unlike PPP, and I know most of you are familiar with that, so I will reference that a few times, this isn't a loan, and there's no payback, there's no forgiveness like PPP was. And then one of the other great parts about it is there's no stipulation as to what you have to do with the money once the company receives it. If you remember from PPP, it was payroll, rent, utilities. This is completely up to your discretion on how you guys use this funding. Can use it to buy a new building, expand, pay back loans, owner distributions. Really, the sky is the limit from that aspect. Does not impact PPP loan forgiveness. So you're able to take PPP and also qualify for ERC. And it doesn't impact that forgiveness, and we can talk about that specifically, okay, if we get into that. But I know there's a lot of people out there that maybe have not gotten the second round of PPP forgiven yet. And again, it does not require a reduction in revenue. So qualification, there's two main ways in which companies qualify. The first and the original was a reduction in gross receipts or a reduction in gross revenue. And it was massive. From 2019 to 2020, you had to have a 50% reduction in gross revenue or gross receipts in corresponding quarters. Corresponding quarters is Q1 of 2019 to Q1 of 2020, Q1 of 2019 to Q1 of 2021. And then when they expanded into 21, they reduced it, but brought it down to a 20% reduction in gross receipts, again, in that corresponding quarters. What the IRS realized and what the federal government realized pretty early on was that there were companies that were impacted outside of just an overall gross receipt reduction. A lot of companies shifted, went to online learning, went to, hybrid type of environments to be able to survive. And fortunately, a lot of organizations were able to thrive during that period. And they didn't want to leave those companies out from being able to apply for this. And so the second qualifier that opened up, and this came into play probably March or April of 2021, looks at a full or partial suspension of operation. Now, a full suspension of operation is exactly what it sounds like. You guys closed your doors for a week, a month, a quarter, a year, whatever that time period is. But a partial suspension of operation, when you get into what the IRS guidance is on this, is extremely broad. And it really almost comes down to anything that may have inhibited your ability to operate your business as you were doing pre-pandemic. So some examples of that are not being able to hold classrooms, in the same manner, having to adjust sizes, having to, go to a hybrid type of environment. And we'll get into a few more of those as we go through here. And then the second part of that qualifier is an area called nominal effect. And I just want to put that word out there because we'll get into that a little bit more as we go through this. So some qualification categories that we look at, what were your 2019 versus your 2020 and 2021 meals and entertainment costs? What were your travel expenses between the years? Additional expenses or costs to the business to deal with COVID, increased sanitization measures, having to bring in somebody to sanitize, having to bring in additional staff because of limitations on how many kids per teacher, per staff member, the ratios were at. Not being able to attend conferences and training events, or they were canceled or went virtual. How you engage with students, teachers, and parents. A lot of organizations that we've run across were not able to engage with parents. Parents had to stay in their cars while they were picking up kids, and there wasn't that same interaction that went on before, which really kind of inhibited their ability to market and bring in new parents and new students into their organization because they were basically shut down to anybody outside of the staff and the students that they were servicing. And then what other changes did your business make in response to COVID-19? So things like plexiglass barriers and having to provide masks and gloves and hand sanitizer to everybody, and spacing desks or tables out 6-foot social distance, and what kind of impacts those had on your individual classrooms and areas within the business. What did you not do now or during COVID that your business used to do? So a lot of organizations that we've talked to talk about first and second shift, and a lot of those had to end second shift. A lot of those had to end after school or before school care. And so those are some areas of impact that we definitely look at. How are your office and administration operations impacted? Did your office have to work from home? Were there too many people in a small area to be able to work, and comply with social distance guidelines? Classrooms were impacted, reduction in size and ratios. And how are your new enrollments? Okay, as we said, not being able to interact with parents and new people coming into the school could really impact those new enrollments. And then the other factors that impacted new enrollments, the fact that most people were working from home and didn't necessarily need childcare, and what impact that had on your organization. And then how are your before and after school activities impacted? Those are areas that we look at. So some areas of impact at other schools: shut down for some period of time, week, month, quarter, whole school year, depending on what jurisdiction you're in. Classroom sizes were impacted. Okay, how to comply with social distance guidelines. Again, additional expenses or costs, okay, due to COVID, increased sanitization, PPE, not being able to attend training events because they're all virtual or completely canceled at that point in time. Classes going virtual or hybrid for a period of time, office or administration activities going virtual, limitations on enrollment due to capacity restrictions, and then having to bring in additional staff or teachers to comply with class size restrictions and ratios. So before I get into, I'll get into FAQs, it gets in here. So what's the processing time to know if I qualify for ERC? Our initial process when we bring on a company is typically about 4 to 6 weeks from the time we get the documentation until we're able to come back to them and let them know what they qualify for. From that point, we're able to tell them what they qualify for in 2020 and then each quarter of 2021. When will my company get paid, the ERTC money? Currently, the IRS processing time is about 20 to 25 weeks before the companies are seeing checks in hand. I say that, however, we have seen an overwhelming number of filings get processed in a much shorter period of time. So we feel like there's some hope on the horizon, as far as how quickly companies will start to receive this money. We see that time frame really shortening and speeding up for companies that are filing now. Our PPP2 loan forgiveness has not been completed. Perfectly fine. ERTC filing will have no impact on your PPP loan forgiveness. And this is a common one. My CPA already looked at ERTC and determined we do not qualify. Most CPA and accounting firms haven't stayed up to date and haven't, tracked the changes in the ERC program. And I want to go back to those 2 qualifiers real quick. The original qualifier, that reduction in gross receipts, when I speak with a lot of CPAs and accounting firms out there, that's the lens that they look at this through. They don't look at the full or partial suspension of operation, or they don't fully understand what constitutes a partial suspension of operation. You not being able to enroll new students into classes because of classroom sizes or limitations due to COVID restrictions was a partial suspension of operation. Not being able to expand your facility due to COVID restrictions is a partial suspension of operation. Having to go hybrid and change your normal mode of operation, that's a definite, clear definition of a partial suspension of operation. And so those things are lead-ins to qualify you for ERTC, where a lot of CPA firms and accounting firms and tax professionals didn't really look at it through that lens and understand that side of it. And again, no fault to them necessarily. The IRS didn't do the best job about getting this information out to people so that they really, could focus on it and take advantage of it from that aspect. So when is documentation required? So our additional document requests includes PPP loan forgiveness, original 941s, payroll details, profit and loss statements, and then a client questionnaire. And that client questionnaire really goes through how you were impacted, what changed in your day-to-day operations, what did you have to adjust that you weren't doing prior to COVID, and talks about your enrollments and talks about how you interact with clients and interact with parents and interact with students and providers. Really kind of gives us a clear understanding of how you guys were impacted on a day-to-day basis. So what is a partial shutdown? IRS guidance on partial shutdown is extremely broad. Again, can mean several things. Again, limitations on capacity, reduction, okay, having to go appointment only, bring in new enrollments, limited services, so having to change what services you offer to clients, having to comply with social distance guidelines, health department orders. I speak to a lot of childcare organizations as we do these presentations to different groups, and a lot of them had to shut down for periods of time, maybe not the whole operation, but individual classrooms because of exposure or potential exposure. And it wasn't just one child that they had to, send home. It was a full classroom and a teacher for 14 days. Well, that really impacts your business, okay? And you not being able to operate an entire classroom of people, that's a partial suspension of operation. So there is just a laundry list of what qualifies under that partial suspension of operation. So my company already took PPP money. Can they also qualify for ERC? Absolutely. December of 2020, this rule changed. Originally, it was you could do one or the other. This rule changed and you're able to take advantage of both. For companies and organizations that did take both rounds of PPP and apply for ERC, there is an offset between the two that we can talk about, okay, on an individual basis. It doesn't mean that you're gonna, not qualify for anything, but there's an offset. We're not allowed to use the same payroll for both programs. And so we have to look at how you use that PPP money. Was it used for just payroll, or did you use it for some of the other allotted items like rent and utilities and some of the other things? And then how quickly you use the money and what coverage periods you guys selected. So there's a lot of things that go into that, but just keep in mind, you can absolutely still take advantage of ERC if you guys took PPP. My company did not have a reduction in revenue. Can we still qualify? Yes, there are still qualifications for companies that did not have a reduction in gross revenue. It's no longer a requirement to have that reduction in gross revenue. The second part, I want to talk about that qualifier again, that partial suspension of operation. The second part of that is an area that the IRS calls nominal effect. And I don't want to get into too many details because I could spend hours on this and it's kind of boring from that aspect. But the part of this, the nominal effect looks at the revenue on a much more granular basis, lets us break it down kind of sector by sector. And that nominal effect looks for a 10% decrease in revenue in particular sectors of the business. So some of the areas that I run into a lot with childcare organizations and private schools and early education centers, when they had subsidized versus non-subsidized parents, they saw a massive reduction in their non-subsidized tuition coming in and not necessarily their subsidized tuition. And a lot of organizations saw a 20, 30, 40% decrease in that area. Particular age groups where they weren't able to continue to offer that service, they would have a complete decrease in that sector of the business, typically infant care and very early, very, very young students or kids from that aspect. After school and before care school, that was limited for a lot of people for some period of time. And so that was a reduction in revenue, not being able to offer those services. And even though it doesn't meet, the requirement for the overall gross receipts, it does meet that nominal effect if we can identify areas of the business that are down by 10% or greater. And we can talk about that, okay, as we go through this a little bit more, but I just want you guys to be aware, you don't have to have this massive decrease in gross receipts. There are other ways that we can look at the revenue in order to qualify your company. So again, my business is having a great year. We made more money in 2020 and 2021 than we did in 2019. Do we qualify? So again, yes. You do not have to have that massive reduction in gross revenue. My company was an essential company during the pandemic. Do we qualify? Yes, there are still qualifications for companies that were deemed essential. Depending on the state, there were a lot of childcare organizations that were deemed essential in order to take care of essential workers' children. And there are still plenty of mandates that those organizations had to comply with that impacted their business. And so there are still plenty of qualifications for essential businesses. So talk a little bit about some of our results. So Jorns Associates, we've processed a little over 5,000 ERTC filings to date, just under $4 billion worth of ERTC money to companies out there. And these are not all childcare organizations, but we have worked really heavily with childcare organizations and private schools and religious schools and other early education centers. And these are just some of the results that we've gotten off of some of these. And obviously sizes vary. So the amount of money that companies qualify for is all dependent on the payroll that they pay and the number of employees that they have. So, religious school at 90 employees, they qualified for over $1 million. Susie Day School, 50 employees, almost $500,000. Here's a preschool at 10 employees for $100,000. A franchise school, 34 employees, $646,000, and the list goes on. And we have just done more and more and more of these on a daily basis where we've been able to qualify them for some significant money. And every organization I talk to has a different goal and different plan on what they're going to do with the money. A lot of them are going to expand, buy a new building, expand their building, and be able to maintain and preserve their organization, for years to come. And that's what this money is designed for. So as a CPA firm, our fee structure is based on a contingency. We charge a 20% contingency fee based on the money that our clients receive. That 20% contingency fee is not due until the checks are actually received by the company. So there's nothing, no real financial risk from the company standpoint. We do ask for a small deposit. It's $2,600. It's fully refundable. So if we start going through this process and we realize that your organization does not qualify for some reason, that $2,600 would be immediately refunded back to you. And nothing gained, nothing lost, but we spent some time and explored the option. Otherwise, that $2,600 is just credited towards that contingency fee. And one thing I want to touch on, and I touched on this in some previous webinars and presentations that I've done, we are here to help, from an education standpoint. Even though this is our business, if you have questions, if you're working with your personal CPA or a tax advisor, and maybe you want to double check their information or ask some questions specific to that, please feel free to reach out. I'm more than happy to talk to you about the program and what aspects may impact your business or may not, and the information that you're receiving from your CPA. And then if you're considering moving forward and talking with us about it, and your CPA is concerned or has some additional questions, I encourage you that if we schedule a call to discuss this, bring them on. Let's have a conversation, because this is your trusted tax advisor, and generally you've created a relationship with them, and we want to make sure that they're comfortable with the situation, and you are as well, and they understand all of the facts of the program and how we're looking at it and how we're qualifying your company. Because in the end, when you receive $200,000, you're going to go back to your CPA to help you to clear that and work in your taxes from that aspect. And we want them to be involved in the process. So, our process steps and timeline. Typically, we'll do a Zoom call that will run through some information very similar to what we did today, maybe a little bit more in detail as far as process goes. We have an engagement letter that spells everything out in black and white, and I absolutely recommend that whoever you work with, make sure everything that you're getting is in writing so you know exactly what services are being offered, what fees are being charged, and what to expect at the end of the day. Complete questionnaire provided, and then we'll provide that document request. And again, the documents are 941s, payroll details, PPP loan information, and then some of the profit and loss statements. Once we have that documentation, like I said previously, we're typically a 4 to 6 week turnaround to be able to tell you what you're going to qualify for in 2020 and each quarter of 2021. Once we've done that, or at the same time, our processing team or our qualification team is going through and looking at those mandates. There are 12,000 mandates that impacted businesses from coast to coast, from the federal level all the way down to the municipal and county levels. And I've never run across a business that wasn't impacted by mandates. And I've never run across a childcare organization that wasn't severely impacted from a lot of those mandates. And so we'll be able to look at those mandates, look at that questionnaire, and then the the revenue data, and then tie all that back to the IRS guidance on this. Once that piece is done, okay, we'll review everything with you and our accounting team. Your 941s will be generated, or your 941Xs will be generated. Final CPA will review them. We have 3 CPAs that are involved in every single process. One looks at the numbers to make sure that the numbers are exactly what they're supposed to be. The second looks at qualification, and the third is the one that looks at the big picture and signs off and files with the IRS. Once the CPA mails the documents over to the IRS, approximately 20-25 weeks, okay, before we're seeing checks in hand. And remember that timeline is speeding up a lot, but I don't want to set any unrealistic expectations from that aspect. And then once you receive the checks, okay, you'll receive an invoice, okay, for that remaining balance of what's due to the firm. So whoever you work with, whether it's us, your personal CPA, accounting, okay, any tax professional, you want to make sure that you're getting everything in writing and you understand the process as you go through this. So I see a lot of stuff going on in the chat. I can't actually see it. So I know, Storm, you were going to kind of go through the chat, and we were going to kind of answer some questions from that aspect. As we get through this, this is my phone number. That's my email address on the screen. Please feel free to reach out to me. The phone number that's on there is my cell phone. Text, email, call. I'm pretty readily available. Email is probably the best way. And then I've got a calendar link that I think we're going to be able to post, okay, where if you want to set up a call with me, go through some information regarding your individual company, whether you decide to go with Jorns or somebody else and you just want to have a conversation about it, more than happy to do that. And the easiest way is through my calendar link, and we'll get that over to you guys. Storm, I think it's you.
Hey, hi everyone.
Jeremy.
Yep, go ahead, David.
Jeremy, you want to address the, we've had a couple people ask about is the money from ERC taxable? And I know you and I dug into this last week. We found some situations
absolutely.
where it might not be. So
at the end of the day, yes, it is going to be a taxable event. It is considered miscellaneous income. We have some guidance, and I want to preface this before, please don't take any of this as accounting advice. I am not a CPA, and I don't know your specific situation. So that's a very difficult question to answer, on each individual person. Everybody has a different tax situation, whether it's a C Corp, an LLC, an S Corp. So, you definitely want to talk to your accountant from that aspect. Now, is it taxable? It can be considered miscellaneous income. One of the unique things about what the IRS did with ERC is this income can be claimed in the actual year in which the credit was allotted to. So if you receive, I'm using round numbers, 10,000 for 2020, you can go back and amend your 2020 tax return and take that credit there where you were probably impacted and maybe had a loss. And the same thing with 2021. There are a number of ways in order to claim the money. I do have some guidance on it. And as we go through this process, I'm more than happy to provide it to you guys.
Thanks, Jeremy. That was a really
absolutely.
great and thorough answer. And then David, I don't know if you wanted to go ahead and ask Jeremy the additional questions, or I'm happy to as well.
I think we got most of them.
All right. I think there was one additional one. Since the pandemic, we cannot find staff to work for us, so we cannot enroll children. Would that count in any way?
So not being able to find staff, not necessarily, but not being able to enroll students means your new enrollment numbers are impacted. So going back to that, I'm going to use the nominal effect side of things. What we would look at is look at the revenue that you generated in 2019 versus the revenue that you generated in 2020 and 2021. Specifically looking at new enrollments and what that did for the organization, and that's how we would probably end up being able to qualify you. So we can look at not just revenue, we can look at actual numbers as far as number of students. There's a number of different ways to look at that aspect. One of the other things, okay, and I'm not seeing it in the questions, but I definitely ran into this in the previous webinar that I did with another organization, is there are provisions provisions in ERC for companies that were purchased through, during the pandemic, started late in the pandemic. There's even a provision called the Startup Recovery Fund, which provides significant money to companies that were started in 2020 and 2021 that may not have that baseline in 2019 to look at and compare to. And it can be worth, for a new company that was started in 2021, it can be worth up to $100,000 for that company, even if you guys just started, kind of in the heart of the pandemic.
All right, perfect. David's been really on point addressing things in the chat. If there are questions you want to just reiterate for people who may be on their phone or maybe not seeing the chat, would you like to do that now?
Sure. Some of the things we've run into, especially with the older kids, is the extracurricular activities that were canceled. That also qualifies you. So if you had sports team or some kind of summer activity, all those things help qualify you for ERC.
And that's another one, David, that I want to address.
Yeah.
I just did this morning with a child care organization out of North Carolina. They had summer camps, and that was a very big part of their revenue during the summer and winter camps, during their year, and they kind of banked on that. And during COVID, that completely ended. They had no more summer camp. They had no more winter break camp.
Yeah.
And so that was a significant loss in revenue that they were not able to pick up in any way, because people weren't sending their kids to camp in the middle of COVID because they were home. So keep that in mind. And when we're looking for qualifiers, we'll sit down and have a full conversation with you and just kind of understand your individual organization to see where that impact was. A lot of times I run into people that we weren't impacted during COVID. We made money. We were able to continue to operate. When we really start digging into it and we look at it through a little bit different lens, we're generally able to identify areas in which you were impacted that you may just not realize, because you're it's like being a little too close to the forest to see the trees.
Jeremy, you want to tell them about the actual process the IRS goes through? We had several questions about what happens if I get audited, or has the IRS audited this, about how they approve them up front, where it's
sure.
Yeah.
So just a little point on how we prepare, our filings as we go through this. We overqualify people. Our process takes a little bit longer than some other firms out there because of the process that we've put in place. There's a detailed qualification report that goes along with every single filing. And we will not file a filing for anybody unless we are 100% sure that it's defendable. The IRS has been very clear. They're not interested in auditing people. They're not interested in fining people. They don't have the manpower or the bandwidth to even look at every single one of these filings. And so they've come out publicly and stated we're spot checking 1 in every 5, 1 in every 10, 1 in every 15, whatever metric they're using. And so it's been our policy from day one that every one of our filings has to be airtight. And with that overqualification, we attempt to answer every question that the IRS could pose prior to them ever posing it. And to date, we have not received any requests for additional comment, information on any of the filings that we've submitted, which we definitely attribute to our process. As well as the fact the IRS is understaffed. So that I think that lends a little bit to it. In the worst case scenario, and the IRS did pick your file and did look at it and did have additional comments, in our engagement agreement, there is a long-term audit support clause, and we have to be there to assist, defend, and answer any questions that come up. IRS has again been very clear. They've taken all fines and penalties really off of the table unless they declare, somebody made documents and, complete fraud from that aspect, because they understand that their rule book isn't clear, and wasn't done necessarily to the best of anybody's ability. So, in the worst case scenario, if a company or if your organization would get audited, they look at quarter by quarter quarter. Everything is processed on an individual quarter. And so it's not very likely at all, okay, probably would never happen where they would audit an entire company. They would audit a specific quarter or quarters. And the worst case scenario that they determined that you would not be eligible for the money that you received in that quarter, and that money would have to be paid back. In our contract, there is a clause that if you get audited, we will defend you. And if you do have to pay anything back, any fees associated with the money you pay back would have to be paid back by Jorns, and we would have to participate in that as well. So that's another aspect that I would definitely look at if you're talking to your CPA or accounting firm or tax professional or whoever you're talking to about this. Make sure that they're going to be there to assist and defend you, and they're going to participate if the IRS does choose your file and it does go down that route. IRS has also been pretty clear. There's not a increased chance of audit. This is a typical. It's not a typical tax credit, but they're treating it like a typical tax credit. So this is a normal process for them. A lot of people get scared when you hear, amended return, but we're amending the payroll return, and that is the method the IRS has given us to claim this. And so it's not out of the ordinary and doesn't, increase audit risk or anything like that.
Yeah, unlike PPP, that was very easily defrauded.
Yes.
And this is part of the reason they've amended ERC. It's almost impossible to cheat because it's based on your 941 returns. So
you've already filed.
You've already filed. So it's pretty easy for them to check and just make sure that you've got the number of employees. You can't claim you have 300 employees when you have 5, which we've all seen on the news happen with PPP. And they need to go back and audit a lot of those PPPs. But this is extremely hard to get around since you filed these things already 2 years ago, some of them. So you can rest assured, I don't think there's going to be issues with audit just from the process.
This is great. Tammy Moss had a follow-up question for the employees. Do you get an average of those?
So it's all quarter by quarter. So we'll look at 2020, and it's typically the average over each quarter of 2020, and then 2021. And so just to kind of get into that a little bit, the calculations are broken up between the 2 years. And so 2020 is worth $5,000 total per employee. That is the max benefit that's available in 2020. 2021, they expanded that and broke it down on a more quarter by quarter basis. And so every quarter in 2021 can be worth up to $7,000, per employee, Q1, Q2, and Q3. So total of 21,000. You add the 21 and the 5 together, and that's where we get the 26. So we'll look at the average number of employees over the quarter. And then what was paid in payroll and Social Security and Medicare and all of those things. And that's how that calculation is completed.
All right, perfect. Thank you. And does that answer your question, Tammy? All right, perfect. And then we do have one Q&A that came in. It says, so it's so much money per employee. Do some owners share that money with the employees as a benefit? And does that make the employee pay the taxes on it?
So how you guys want to use the money is completely up to you. But because it would be considered miscellaneous income to the company would be responsible for the taxes. There would obviously then be an offset if you gave that money to the employee. So again, that's probably a CPA or your accountant's question on how you guys want to address that based on your structure. I do know some organizations that have shared ERC with their employees. It's completely up to you guys, again, how you want to use that money.
Thank you. Great clarification. And we have an additional question. If we get into contract with you to help us with the ERTC, and then we get an audit from the IRS, what is your fee to represent us in the ERTC audit?
So there's no additional fee. It's just, it's in our agreement. It's part of our agreement already. So we would have to be there to support that through the statute of limitations on the ERTC audit, if there's an ERTC audit. So there's no additional fee on top of anything else.
Perfect. Any other questions that we could go ahead and address today together?
So one other thing I do want to address is if you have already gone down the route and looked at ERC and filed for ERC, we definitely want to look at what quarters you filed for. What we have run into a lot is some CPAs and accounting firms, had an understanding of that first qualifier very early on, that reduction in gross receipts, and were able to qualify companies based on that, but they didn't look at it through the other lens. And so a lot of times what we'll see is companies that filed for, Q2 and Q3 of 2020, and they got a little bit of money out of from that aspect. But then when it came into Q4 and Q1 and Q2 and Q3 of 2021, there wasn't that reduction in gross receipts. And so they didn't file for that. We can definitely go ahead, or they can go ahead, whoever you want to work with can go ahead and look at those other quarters. But keep in mind, if you guys didn't file for all of 2020 and the first 3 quarters of 2021, we want to make sure why you didn't file for that, okay? And you looked at it through all the with all the qualifications in place, and you might have left some money on the table from that aspect, and we see that a lot.
One thing I wanted to throw out, I did some calculations on the schools we've done so far. And if you got both PPP loans, the average is still over $19,000 per employee, even with both forgiven. That's pretty significant. If you didn't get PPP, it's even more.
All right, wonderful. Well, we have Jeremy and Dave here for another 15 minutes. So if you guys would like to address any more questions, don't be shy. Please feel free to share them, because if you've got that question, I'm sure someone else does as well.
Jeremy, Ryan's asking that he read PPP and ERTC could not be claimed for the same quarter. That's not true. It's just you can't use the same payroll. But
Yeah. So the rule on it is that we're not allowed to use the same payroll. And so to kind of get into that, if a company, and I'm going to use, it's different for 2020 and 2021. So I guess let me address both of those. For 2020, for PPP round 1, the way the calculation for ERC is done is we look at all, even though we qualify all 4 quarters, we kind of have to combine it and look at it as a whole for the year. And so the ERC qualification and calculation for 2020 is we're allowed to look at the first $10,000 of employee earnings. We're allowed to take 50% of that towards ERC, or $5,000 per employee, and that's where that maximizes. Most companies that took PPP round 1 took it in Q2 or Q3. So there are still other quarters in which to make up that $10,000 worth of employee earnings to meet that $5,000 max benefit. We rarely run into a situation where companies in 2020 have an offset because there's just so many other quarters to make up that payroll. So that's how PPP works in 2020. 2021, they changed it. Instead of on an annual basis, they did 70% of the first $10,000 per quarter. So Q1, Q2, and Q3. So if an employee makes $10,000 per quarter, you can maximize that benefit of $7,000. PPP2 typically impacts Q2 of 2021. Well, when we look at the payroll for Q2 of 2021, there's typically not a ton left over after PPP, unless funds were used for rent, utilities, and some of the other items. And so that's where the biggest offset comes in. But it does not mean that you don't qualify for both, because we still have Q1 of 2021 and Q3 of 2021. And then we see a little bit of an offset for that, for that second quarter of 2021, assuming that they took both rounds of PPP. I know that's a little complex, so I just want to make sure you understand that. Sorry, I just see Brian. Okay, what's the ballpark percentage of applicants who will qualify? I'm going to speak specific to childcare organizations. I have not come across the childcare organization that I haven't been able to find a qualifier for, and they're pretty clear and out there. I believe when this program was designed and crafted, it was crafted with the restaurant industry in mind, because there's a lot of provisions that lean that way. And what I see with childcare organizations that mirrors the restaurant industry is, it was, okay, you can open, now you have to close, now you have capacity rates and you have ratios that you have to follow, and every state had different things. And so there are just so many limitations that were put on your industry that we just haven't been able to, haven't run across somebody that wasn't impacted.
Let's see, Jeremy, there's
so I see, Beth, can you represent other businesses? Okay, or just childcare? So we do this across the board, from everything from, manufacturing to, car dealerships to restaurants, movie theaters. I mean, any business that's out there that has employees can be eligible for ERTC. W-2 employees, again, we use that 3 to 499 number. So doesn't matter what industry they're in. Okay, so I'm sure a lot of you have other business lines and or spouses or friends with other businesses, and absolutely we'd be happy to talk to anybody.
all right. Someone's asking about what if you received money from the Child Care Relief Fund?
So every state has some different childcare relief programs and incentives that they help their organizations with. If those funds were meant and directed towards your employees specifically, like PPP, then there could be an impact. I have not run into any particular state or federal grant from that aspect that impacts it at that point. Again, I probably haven't worked with a child care organization in every single state, so there may be some states out there that I'm not 100% aware of. But the only things that I know that impact ERTC by the guidance is if those grants or relief funds were specifically allotted to your employees versus your overall business. And most state grants and even some of the federal money that was out there was not specific to employees. It was the overall organization to help with lost tuition or increased maintenance or sanitization and things like that. So PA now has a workforce grant that they're getting ready to disperse. I'll have to look at that, Beth, specifically for PA and what time period that covers, because we're looking at 2020 and 2021. And if that grant is, going to be allotted now, that's probably for 2022 and 2023 moving forward. So it may not have that impact. So we'll have to look at that one specifically.
Hey, Jeremy, I think you probably have already answered it, but just in case it was overlooked, one question: what's the ballpark percentage of applicants who qualify?
So ballpark across every industry that we talk to, probably in the 90 to 95%. In early education, childcare, schools, I don't want to use the 100 because I'm sure there's somebody out there that I'm not going to be able to qualify for some reason. I just haven't run into them yet.
All right, perfect. And we have a direct question. If we own 2 businesses, is the fee for each business?
Yes. So every filing that we do, it's a great question. Every filing that we do is treated individually. And so we'll have to have everything separated, a separate engagement agreement, separate fee, separate documentation from that aspect. And the same holds true if you have a multi-unit business where you have 3, 4, 5, 10 locations. If they are all separated, have separate EINs, we'll have to file individually for each one of those organizations. As I bring that up, I want to talk about something real quick that's really important, and it's come up a lot recently, and that's something called aggregation. And I'm not going to get into all the definitions and what aggregated and what isn't. But keep in mind, if you're if you have multiple entities and the ownership structure is basically, the majority ownership structure is basically the same across all of those, they can be considered an aggregate. And there's a benefit and a positive and a negative to that. The positive is if one entity qualifies, all of your entities qualify. The negative to that is if you exceed that 500 employee mark because of the aggregation, then you would be ineligible for ERC. So those are the positives and the negative. I haven't run into a childcare organization that I have that, I've had that issue with yet, but other industries we have where they end up exceeding that 500 employee mark.
All right, wonderful. Dave, is there anything else that
just that I think the hardest part of this for everybody is just accepting that it's not too good to be true. We got Bob to help us get this information out there because it's hard to, the childcare industry, it's shocking how few people have even heard of this program. And we've been working on it for over a year and a half, getting companies money. But we found childcare, especially, I think the owners are just busy. You put a lot of hours in and it's almost no one's heard about it. So anybody that got something out of this presentation, please pass it on. We'll never see another program like this in our lifetime. And whether you participate in it and get funded from it or not, trust me, you will be paying for it in the future. So anybody that has any moral qualms about taking this free money, you're going to pay for it one way or another. So I suggest that you participate and prepare for that. Have a few $100,000 extra in the bank to cover the future taxes.
And Dave, let me just touch on one last point that we did not touch on, and that is when this expires.
Right.
There is definitely a timeline, okay, on this program. The timeline based on the guidance, we have plenty of time. We have 3 years from the original 941 filing date, so we have the time from that aspect. The unofficial timeline is when the IRS and the federal government decide to end this, and we ran into a situation last year. In late 2021, where they snuck a provision into the infrastructure bill that canceled Q4 of 2021. It took $7,000 from every company that we had already qualified and every company that hadn't qualified yet out of the running. And it was an absolute disaster to companies. And they can do that at any point in time. Obviously, it takes it back to Congress, and there's a lot of things that go into that. And so we'll have some leeway, and we'll know when that's going to happen. If you are filed, you're grandfathered in. They could, if you file today and they end it tomorrow, you're going to receive your money. They have to pay you. It's in, it's in the guidance that's been with the IRS for decades. So, definitely keep that in mind from that aspect. And then the other thing it just kind of came to my mind. I received a phone call, and it's just I don't want to be just a word of caution. I received a phone call from somebody that we had assisted, asking if I could help out a friend of hers who owned a number of childcare organizations. And I got on the phone with her, and she was thrilled to death. She had qualified for $400,000 for ERTC and was just as happy as anybody I've ever talked to, until I told her she should have qualified for about $5 million worth of ERTC money. And she was in tears. They have over 300 employees. They've got 13 centers. And the organization that did this for her just did it wrong. And very wrong. It is a nightmare to unwind. There is a possibility of unwinding it. It's much harder to unwind than it is to do it right the first time. And so I want to keep everybody, just aware of that there's a lot of people that say, I understand this, and that don't understand it. And we run into it every day. And I just want everybody to maximize what's rightfully yours, because if you don't step in line for this, somebody else is going to.
There's a lot of great accountants out there, I'm sure, just like there are a lot of great attorneys, but you don't use your real estate attorney if you get a DUI or, if you're getting a divorce. It's a specialized type of accounting. And I believe there's now 4,000 pages of guidance on this from the IRS.
So it changes
It grows every day.
Yeah.
And it's, you know, it needs to, it's all we do, and it's still all we can keep up with. Also, someone asked, I wanted to clarify, even though it's a tax credit, you do receive checks in the mail. This is not like a credit on your tax return. You get actual checks from the IRS. It's a refund of taxes that you overpaid, basically.
Yeah. And you'll receive a check for each quarter that you qualify in. And on top of that, in the IRS guidance, they have to pay you interest on the money that they're sitting on. So you will end up receiving, you know, even more than that, you know, on 2020 and 2021, because they've technically been holding on to money that is rightfully yours for that period of time. So they do pay interest on it. It's not much, but it, you know, it's a nice little bonus when you get the check.
Well,
All right, we
David
had
and
just
Jeremy.
one point. I'm so sorry. We had one point of clarity about 2 EINs. It's due, one individual filing is due per EIN. Is that correct?
Correct.
Okay.
Yes.
Thank you. All right, go ahead, Cindy. Wrap us up.
Hey, well, first of all, David, I like what you said about the thing that's hard to believe is that it's not, that it's, you know, it isn't too good to be true. Because typically things like this are too good to be true, but I don't know. And I hope I don't offend anything, but I have to think it's a bit of a God thing, because the industry is really struggling and it doesn't look like we're going to get much help, you know, in this year's or in the coming year's budget or any type of childcare plan. And this kind of help to childcare centers extends, you know, not only to owners and staff, which deserve some, you know, additional funding for what they do, but also for children and families. Because anytime there's an investment like this, our childcare owners out there, you know, are going to put it back somewhere in their business. And that benefits, you know, our world of children and families and what we stand for. And it may actually help them make our providers make a living, you know, because sometimes they're the ones that go without a paycheck.
Yep.
So I can't thank Bob and Caroline enough for bringing your group to us. And then also would like to encourage all of the participants to, you know, tell at least one other childcare center in your area about this opportunity so that we can spread this out and help all providers.
Thank you so much, Cindy. It is that time. I just again want to say a huge thank you to our presenter Jeremy and co-host David, as well as Caroline and Robert for really bringing this to our attention. I know that everyone's really enjoyed the presentation and taken a lot away from it. So we will send out contact information for both Jeremy and David, as well as those attendee certificates, the post-viewing survey, and the recording, so you can share it with other people and get started on this amazing opportunity. You definitely don't want to miss out on. And just in wrapping up, remember that the key of all of this is, you know, childcare and having an investment in childcare. So please be sure to use the link that we put in the chat. Please locate your legislators for whatever state you're in. Please be vocal. Please do not sit silent. This is an amazing opportunity for you to get some extra funds to really help out your centers and, you know, continue on with your good work. But remember that it all starts at the Hill, unfortunately, and we do need you to be vocal so that they'll make those investments in childcare that they've continuously been putting on the back burner. So thank you all for attending. Please be advocates. Please take advantage of this amazing opportunity, and we'll see you in the next one.
All right. Thank you.
Thank you guys. Appreciate it.
Hey,
And
thanks,
don't forget,
everyone.
we love talking to accountants. We've had
So please, by all means.
We'll take that responsibility away from you. We love talking to accountants and bookkeepers. So anybody that feels like they're in the middle and their accountant tells them, oh, you don't qualify, just put them on the phone with us. By the time we're done, they'll definitely see the light.
Yeah. And if we can make sure, okay, part of that goes out, if you can make sure my calendar link is in there, and that way if people want to book specific time, we can do that as well.
Absolutely.
Okay, perfect. Thank you guys. I appreciate everybody who attended. Thank you.
Have a good one.
Thanks, everyone.
Bye.
Hey, take care.